Redfin just published a new housing market report where they said America will become a renter nation in 2025. Why are they saying this? Two reasons. Number one, they believe houses are going to get more expensive in 2025. And number two, they believe that mortgage rates will stay high at around 7% through 2025. These two things will make buying a house less affordable, which will make more people want to rent instead of buy. In fact, this is what they said. Quote, rising prices are one factor that will keep home ownership out of reach for many Americans, leading some would-be home buyers to rent instead. And it gets a little bit more interesting when we take a look at younger people who are considering buying a home and looking for ways to deploy their money. This is what they said about Gen Zers. Gen Zers will keep living with family or renting until well into their 30s, opting to build wealth in other ways. Meaning, instead of using their money to build a home or buy a home, they're going to use their money to invest in stocks or maybe other alternative assets. Now, Redfin, for those of you who don't know, is a multi-billion-dollar real estate company. And I want to break down their report, which I've linked for you down in the description, by talking about three key points. Number one, I want to talk about housing inflation. Number two, I want to talk about mortgage rates. And number three, I want to talk about renting versus buying a home. So make sure you watch this video until the end, because Redfin says that they believe houses are going to become 4% more expensive in 2025, which means they're saying house prices are going to increase faster than inflation next year, which is something that we've been seeing for years. If you've been reading market briefs, you already know that the latest inflation number says that headline CPI inflation came in at 2.7%. So general inflation is 2.7%, but the inflation report also said that the reason why inflation is higher than normal is because housing prices keep growing faster than inflation. And this housing inflation is so sticky that it's keeping inflation hot. And it looks like, according to Redfin, that trend is not slowing down anytime soon, because they believe that housing prices are going to continue to outpace inflation. Now, if you have not joined Market Briefs yet, it is my free financial newsletter where my team is publishing what's happening in things like the housing market, the stock market, the crypto market, our economy, and the global economy into a fun and witty and easy to read newsletter. You can read it in less than 5 minutes every morning, and it's completely free. We have hundreds of thousands of investors that are reading Market Briefs every morning. So if you want to get it for yourself, I have the link for you to join down in the description below. But I want to dive a little bit deeper into how much more expensive houses are today versus just a few years ago. Between May 2019 and May 2024, over those 5 years, the average housing price is up by around 54%. The average mortgage payment over those 5 years are up by around 100%. Because not only do you have to borrow more dollars, but you're paying a higher interest rate on those dollars. Versus at the same time, the median household income is only up by around 20%. This is why housing has become so much more expensive, so much less affordable, because incomes are not keeping up with housing costs at all. Not to mention the fact that when you go out and buy a house today that's more expensive, a more expensive house also means you have higher property taxes you have to pay, and you also have to pay higher property insurance costs, because these will vary depending on what the price of the home is. And this brings me to the topic of mortgage rates, because a lot of people were hoping that mortgage rates would fall in 2025. But here's what Redfin had to say, quote, mortgage rates are likely to remain in the high 6% range throughout 2025. Now, if you've been listening to the news, you've probably heard President-elect Trump say that he's hoping that the Fed will cut interest rates many times in 2025, and he wants to bring mortgage rates down in 2025. But this is what Redfin had to say about that. Investors are anticipating that if President-elect Donald Trump implements a significant portion of the proposed tax cuts and tariffs and the economy stays strong, the Fed will only cut interest rates twice in 2025, keeping mortgage rates high. Meaning, if Donald Trump keeps the economy strong through his proposed changes in the economy, then the Federal Reserve Bank will have no reason to actually cut interest rates. Because remember, the Federal Reserve Bank wants to cut interest rates as a way to stimulate the economy. And this has been an ongoing debate that we've been hearing throughout 2024, which is if our economy is so strong, like all the data keeps saying, supposedly, that the economy is growing, the job market's strong, inflation is coming down, if all of this is so true, why are we still cutting interest rates in 2024? And this is where Redfin says, well, if Trump comes into office and he makes the economy even stronger, the Federal Reserve Bank is going to have no reason to want to cut interest rates. And if the Federal Reserve Bank has no reason to cut interest rates, mortgage rates will probably continue to stay high. And I want to dive a little bit deeper on tariffs because Redfin talked about tariffs here. This is what they said, quote, tariffs could be inflationary, and enacting more tax cuts would increase the United States deficit, both of which would push mortgage rates up. So interestingly, this is where Redfin is talking about bond yields. They didn't say it explicitly, but I want to explain what this means. Because what they said is, if we see inflationary tariffs, or if we see tax cuts which increase the United States deficit, meaning the government grows their national debt levels, that could push mortgage rates up, which might have you confused. How does the national debt have anything to do with mortgage rates? And it does, because when the United States government goes out and borrows more money, they have to issue what's called a treasury. A treasury is a loan that somebody makes to the government. You and I can loan money to the government. Foreign countries can loan money to the government. The Federal Reserve Bank can loan money to the government. And when we start to see concerns of high national debt or high national deficits, that then can put more concern on investors who are lending money to the government. Because now you get concerned about the health of the government. You get concerned about the health of the debt. And when an investor gets concerned about their investment, they want a higher rate of return. So now when you lend money to the government, instead of asking for a 3.5% return, maybe you want a 4% return. So higher national deficits through these potential tax cuts or tariffs, which could be inflationary, this is what Redfin says could create more concerns for investors that are lending money to the government who would then command higher interest rates. But how does that impact the mortgage market? Well, if you read any economics textbook, what it will tell you is that lending money to the government is considered a risk-free investment. So, when JP Morgan or any lender is considering investing their money, and by investing their money, I mean lending money, they have to consider all their options. They can lend money to you, they can lend money to your broke cousin Bunty, or they can lend money to the United States government. Now, if the government is a risk-free investment and they're paying a higher rate of return because investors are concerned, then naturally they would want to charge you more money because you are a more risky investment than the government, because the government has the ability to impose taxes. They can work the Federal Reserve Bank to print more money. And because of that, if there are concerns about the national deficit, if there are more concerns about inflation, that could push these treasury yields higher, which would also push mortgage rates higher. And this is why Redfin says mortgage rates will continue to stay high in 2025, while they also believe that housing prices will also go up. And this is why they believe that America is going to become more of a renter nation, where more people are going to say, I'm going to rent longer, or I'm not going to own a home, I'm just going to rent because it's cheaper and easier for me to rent, which brings me to the topic of renting versus buying. And I'm going to be completely blunt and transparent here. There are arguments to be made for both sides. Now, I'm a real estate investor. I invest in rental properties. I am also renting where I live. Now, there's a couple of reasons as to why I rent where I live. One is because I've been traveling so much over the last few years, it is easier for me to rent. Number two is I'm looking to buy a house, but it's just easier for me to rent right now, although I am looking to buy a house. But that being said, the issue that I have is when people go out and buy a house that they can't afford. Now, I became a licensed real estate salesperson more than a decade ago, 13 years or so ago. Wow, it's been a long time. And one of the things that you learn when you become a realtor is when you're selling a house, you're really not just selling a house, you're selling a home. And you're really not just selling a home, you're selling somebody the biggest investment of their life. Now you can start to see where I'm going with this. When you're selling somebody the biggest investment of their life and their dream home, it's a little bit easier to get somebody to buy a little bit bigger and a little bit nicer. It's the same with mortgage bankers. Now, I'm not saying they're bad people. Real estate agents and mortgage bankers have to eat too. They're in the business of selling you homes and selling you mortgages. But you have to understand how the game works. And the problem is, many people believe that the way you build wealth is by buying a house. And now when you believe that you build wealth by buying a house, and then you go get your financial advice from a realtor and a banker, you might end up buying a house that's a little bit too big and a little bit too expensive. And so now most of your income is going to make your mortgage payment, and you have no more money to actually invest. And that's why what I say is I have no issue with you buying a house, but I have an issue of you buying a house that you can't afford. I think it's a good idea for you to buy a house when you can afford it. And this is where you got to understand the game. That's why I say that your house is a liability. Treat your house like a liability. When you do that, now you look at your liabilities, your house, your groceries, your expenses, and then you have separate money to invest. And now you don't commingle the two. Because the mistake that so many people in America make and across the world is they assume that because I'm making this mortgage payment, I'm investing my money. I don't need to invest my money in stocks. I don't need to buy rental properties. I don't need to invest in businesses because I am paying off my mortgage. But that's not an investment. That is a liability. That is an expense. And that's the shift that I want you to make. I'm not saying it's bad to buy a house. It's good to buy a house. I want you to own your house. But I don't want you to own a house that you can't afford. Buy a house that you can afford. And to afford a house, you got to afford three things: the down payment, the monthly payment, and the moving costs. Don't forget about the moving costs, because when you buy that house, your wife is going to want new furniture. She's going to want to upgrade the basement and the bathrooms, and there's a cost to that. So factor that in there. But understand that there are many ways to build wealth. There are a lot of people that go around preaching that the best way to build wealth and build generational wealth is by buying a house and paying it off. The problem with that is you still have to pay property taxes and insurance and the maintenance and the upkeep. And now if your house goes up in value, guess what? Your property taxes are also going up. And this is the mistake that so many people make, is they assume that if I want to build generational wealth, I got to build this house or buy this house and then pass it down to my kids. But if that house goes up in value like you wanted to, well, now your kids just got $1 million house. And now they have to pay the property taxes on $1 million house, plus the insurance on $1 million house, plus the upkeep and maintenance and upgrades on $1 million house. And if you can't afford that, now they can't afford this house. Versus if we compare this to a rental property generates income. That income pays for the property taxes. That income pays for the upgrades. That income pays for the repairs. That income pays for the insurance. Now, sure, it is difficult to buy a rental property, but there are many ways to invest your money. But what I'm trying to get at is there's a difference between investing your money to build wealth and buying a house. Buying a house is good when you can afford it. But there's a difference between that and actually building wealth. And this is where there's nothing wrong with renting. But when you're renting, don't make the mistake of also renting so expensive that you have no money to invest. I mean, you're doing the worst of both worlds, because I think most people assume that just because someone's renting, they can't build wealth. No. If you're renting, you can buy rental properties. If you're renting, you can buy stocks. If you're renting, you can invest in building a business. You can invest in startups. You can invest in a lot of different things. But the whole idea is you got to be investing your money no matter what you're doing. And if you're going to buy a house, great. Just make sure you can afford your house and continue to invest your money, because that's where the real wealth is built. The real wealth is not built through you buying a house and paying it off. Not to mention the fact that banks are not stupid. Banks front load your mortgages. If you go out and get a 30-year fixed rate mortgage like most Americans get, well, for the first 14 years of your mortgage, more than half of your mortgage payment is going to be going directly into your bank's pocket with interest. It isn't until year 15 that at least half of your mortgage payment is going to be going to actually build equity into the principal balance of your house. And so you're going to be spending all this money on your mortgage when you're really not building equity yet. You're building your banker's pockets. Now again, I'm not against you buying a house. I just want you to understand the game and understand that yes, you can still build wealth while you're renting. So if you're renting right now, continue investing your money, continue working to build your down payment, continue to grow your income. That way you can buy a house that you can actually afford. Then when you buy that house that you can afford, make your mortgage payments, maybe pay a little bit extra, that way you can pay it off early, but still have money to invest. outside of your mortgage, because that's where the real wealth is built. And with that, I will see you on YouTube on Monday.